Hi, I'm Russell Rivera, founder and president of Voice Wealth Management. I'm a chartered financial analyst and certified financial planner. I like to think of myself as a personal CFO and financial therapist for entrepreneurs, young professionals, and their families. Today I wanted to talk to you about the possibility of an impending market crash. The last official recession in the United States ended in 2009. Regardless of age, we all remember it. Whether you call it the financial crisis or the Great Recession, it's left an indelible mark on how we viewed our economy over the last decade. Many of us are scarred by the events of that time, and whenever we hear some sort of negative economic event, we're standing there waiting for the other shoe to drop. Fortunately, the current economy and the stock markets of the last 10 years tell a different story. Unemployment is its lowest rate in the last 50 years. Stock markets are still near their highs. And the Fed is now showing a bias towards cutting rates, which is usually helps economic and stock market growth rather than cutting them. That said, worries exist. The trade war with China, the inverted yield curve, and small cap and value stocks that aren't participating the same way that the headline stocks are make people think that the growth is a little bit weaker right now than it's been in the past. With all that as backdrop, I'm going to say one thing. A recession will happen. I just don't know when it will happen. A stock market crash will happen. I just don't know when it will happen. That leaves the question: how are you prepared for the next downturn, and how will you react when it does? Preparation is key. You can start today. Here's how. 1. Make sure you have adequate cash reserves. When people think of recession, they think of job losses. If that happens to you, it means having to pay bills and living expenses with little to no income. It's usually considered good practice to have 6 months of living expenses in cash in case of emergency. Having adequate cash reserves means not having to touch retirement and investment accounts like Roth IRAs, 401ks, and traditional IRAs and taxable accounts. If you do not have adequate cash reserves and you do touch those types of retirement accounts, that means having to pay increased taxes and penalties. Having cash reserves avoids that. 2. Understand your budget. If you don't understand how you're spending to live now, how will you manage when times get difficult? Uber, Seamless, dining out, bars. Where are you spending now more than you thought? Consider cutting some expenses now so that it'll be easier to manage when times get difficult. 3. Check how your accounts are invested. If you haven't done it in a while, now is a great time to check out the asset allocation in your 401k, IRA, and taxable investment accounts. As asset prices are near their peak, your asset allocation may be riskier than you had planned. What better time to bring your accounts into target allocation? Lock in some gains now and you'll be ready to add risk when prices fall. 4. Keep contributing to your Roth IRA. Tax-free growth in Roth IRAs is a great way for younger and lower income savers to grow assets. In addition, your Roth IRA could be used as a place to tap assets in an emergency. While it's always appropriate to have adequate cash reserves, you could use your Roth IRA contributions to tap in case of an emergency. Of course, this should be a last resort. 5. Be ready for new opportunities. Recessions always bring new opportunities, whether it be the opportunity to use your skills in a new industry, start a new business, or even just take advantage of lower asset prices. Whatever opportunities come your way, don't be afraid to take them. If you need help with your preparation for the next possible recession, email me at russell.rivera@voicewealth.com. Or to set an appointment or learn more about our firm, you can visit our website at www.voicewealth.com. Thanks for watching. I'll see you next time.